Ever feel like your car insurance bill just keeps going up, even when you haven't had a single accident? Well, you're not alone. Millions of Americans are seeing their car insurance rates skyrocket in 2024, and it's leaving a lot of us scratching our heads and asking, why? If you've opened your latest bill and felt a shock, stick around. We're going to break down exactly why this is happening and, more importantly, what you can do about it. It's a frustrating situation, but understanding the reasons is the first step to finding a solution. The reality is, car insurance rates are on the rise all across the United States. It's not just you, and it's not just your state. From coast to coast, drivers are facing steeper premiums than ever before. We're seeing increases that are far outpacing the normal inflation we're used to. This isn't just a small bump. For some, it's a significant financial burden. People are looking at their bills with genuine concern, wondering how they're going to fit this new expense into their budget. It's a national trend affecting everyday people, and it's turning a routine expense into a major headache for families everywhere. The charts don't lie, the numbers are climbing, and it's time we understood the forces behind this surge. So, let's dive into the first big reason: the cost of repairs. Think about the car you drive today compared to one from 10 or 20 years ago. Modern vehicles are packed with incredible technology. We're talking about advanced driver assistance systems, countless sensors for everything from parking to lane keeping, cameras, and sophisticated onboard computers. While this tech makes our cars safer and more convenient, it comes with a hefty price tag when things go wrong. A simple fender bender that used to require a bit of bodywork and a new bumper might now involve replacing and recalibrating multiple expensive sensors hidden behind that bumper. A cracked windshield isn't just a piece of glass anymore. It often houses cameras for your safety systems, making replacement far more complex and costly. These high-tech components are expensive to produce and require specialized training and equipment to repair. So, when an insured car gets into an accident, the claim that the insurance company has to pay out is significantly higher than it used to be. This increase in repair costs is a massive factor, and it gets passed down to all of us in the form of higher premiums. Next up is a word we've all been hearing a lot lately: inflation. It's affecting everything from our groceries to our gas prices, and car insurance is no exception. The ripple effects of inflation are hitting the auto industry from every angle. The cost of car parts, both new and used, has shot up. Supply chain issues have made certain components harder to get, driving their prices even higher. Then there's the cost of labor. Mechanics and technicians need to be paid more to keep up with the rising cost of living, so repair shop labor rates have increased. And let's not forget about medical care. If an accident involves injuries, the cost of medical treatment has also been climbing steadily. Doctor visits, hospital stays, physical therapy, it's all more expensive. Since insurance policies cover these medical costs, when the price of healthcare goes up, the potential payout for an accident claim also goes up. All of these inflationary pressures combine, forcing insurance companies to raise their rates to cover their own increased costs. They're paying out more for parts, more for labor, and more for medical bills, and that financial pressure ultimately lands on us, the policyholders. Now for a factor you might not be as familiar with: your insurance score. You've heard of a credit score, right? Well, in most states, insurance companies use something similar called a credit-based insurance score. This isn't the same as your FICO score, but it's derived from information in your credit report. The logic from the insurer's perspective is that statistical data has shown a correlation between how a person manages their finances and how likely they are to file a claim. Things like your payment history, how much debt you carry, and the length of your credit history can all influence this score. A lower insurance score can signal to the insurer that you're a higher risk, and consequently, they'll charge you a higher premium. It feels a bit unfair, especially if you have a perfect driving record, but it's a common practice in the industry. It means that your financial habits, completely separate from your driving habits, can have a direct impact on how much you pay for car insurance. It's another layer of complexity that goes into calculating that final number on your bill. Another huge piece of the puzzle is simply where you lived. Your location plays a major role in determining your insurance rates. Insurers look at data for your specific zip code to assess risk. If you live in a dense urban area with a lot of traffic, the statistical likelihood of getting into an accident is higher than in a quiet rural town. They also look at crime rates. Does your area have a high rate of car thefts or vandalism? If so, you're considered a higher risk for a comprehensive claim. Even the weather makes a difference. Regions prone to hailstorms, floods, hurricanes, or other severe weather events will see higher rates because there's a greater chance of weather-related damage to vehicles. So, even if you're the safest driver in the world, if you live in a high-risk zone, your premium will reflect the risks of your environment. You're essentially being grouped in with everyone else in your area, and the collective risk of your neighborhood impacts your personal policy. Okay, that all sounds pretty grim, but don't despair. The good news is you are not powerless. There are concrete steps you can take to lower your premium, even with all these external forces at play. First and foremost, shop around. Don't just automatically renew with your current provider. Get quotes from at least 3 to 5 different insurance companies. Prices for the exact same coverage can vary wildly between carriers, and you might be surprised by how much you can save. Second, consider increasing your deductible. The deductible is the amount you pay out of pocket before your insurance kicks in. A higher deductible, say $1,000 instead of $500, means you're taking on more risk yourself, which will lower your monthly premium. Just make sure you can comfortably afford to pay that deductible if you need to. And third, remember that insurance score we talked about. Work on maintaining a good credit history. Paying your bills on time and keeping your credit card balances low can help improve your score and potentially lead to better rates. So, what's the takeaway here? Your car insurance bill is a complex equation, influenced by everything from global economics to your local neighborhood. While some factors are out of your control, knowledge is power. Before you renew your policy, take the time to really understand it. Review your coverage, check your deductible, and don't be afraid to ask your agent questions. Most importantly, be a proactive consumer. Compare quotes, look for discounts, and take steps to improve your risk profile. A little bit of effort can lead to some serious savings. Thanks for watching, and if you found this helpful, be sure to like and subscribe for more tips on how to navigate your finances. Drive safe.